Over the last 3 episodes, we read Redline's income statement, cash flow statement, and balance sheet as if each one stood alone. But they don't. They are not 3 separate documents. They are 3 views of one company, wired together. Change a number on one statement, and it moves through the others by the rules of accounting. Today, we draw the wires. By the end, you'll see why the 3 financial statements are really one system. Start at the bottom of the income statement, net income. Redline earned about $9.1 million. That is the end of the income statement story. After revenue, costs, interest, and taxes, this is the profit the business produced. But it is not the end of the numbers journey. Net income is one of the most connected figures in accounting. It shows up in 2 other places. First, it goes to the top of the cash flow statement. That is why every indirect cash flow statement begins with net income. The cash flow statement starts with profit, then adjusts it into cash. Second, net income flows into retained earnings on the balance sheet. Retained earnings are profits the company has kept inside the business over time. So one number has 2 destinations. Net income starts the cash flow statement, and it builds the owner's equity. That is the first wire. Next, depreciation. On the income statement, depreciation was an expense. It reduced profit by about $4.2 million. But no cash left the building this year to pay for it. That cash left earlier when Redline bought the equipment. So on the cash flow statement, depreciation gets added back. Same number, opposite direction. It lowers profit, but it does not reduce current year cash. And it also touches the balance sheet. Every year, depreciation reduces the carrying value of property, plant, and equipment. That little word net next to PP&E is depreciation doing its work. One charge, 3 statements. Now for the cleanest connection of all. Go to the bottom of the cash flow statement, cash at end of year, about $4.2 million. Now go to the top of the balance sheet, cash and equivalents, about $4.2 million. The exact same number. That is not a coincidence. That is the point. The cash flow statement explains how cash moved during the year. The balance sheet shows where cash ended at one moment in time. Where the cash flow statement stops, the balance sheet picks up. That is the cash tie. Now let's close the loop from the last 2 episodes. On the cash flow statement, working capital drained cash. Receivables grew, inventory grew, payables helped a little but not enough. So where did that cash go? It shows up on the balance sheet. Accounts receivable is money Redline earned but has not collected. Inventory is cash sitting in parts, work in process, and finished product. The cash flow statement tells you cash was used. The balance sheet shows you what it turned into. Same event, 2 angles. Now step back and look at the whole web. Net income flows into cash flow and retained earnings. Depreciation lowers profit, gets added back to cash flow, and reduces PP&E. Ending cash on the cash flow statement becomes cash on the balance sheet. Working capital movement becomes receivables, inventory, payables, and accruals. This is what the statements tie out actually means. It is not a slogan. It is wiring. Every number has somewhere to go. Pull one thread and the others move with it. That is also why you cannot really fake one statement by itself. A wrong number has to land somewhere. If it does not, the system stops making sense. So why does this matter? Because once you see the wiring, you stop reading 3 documents. You start reading one company. The income statement shows performance. The cash flow statement shows movement. The balance sheet shows position. Together, they show the business. You can trace a decision across profit, cash, and financial structure. You can spot errors. You can see when growth is using cash. You can see when debt is carrying the business. And you can tell the difference between someone who can recite the statements and someone who can actually read a company. That is the foundation. Next, We start using these statements to read the metrics people quote in real business conversations. We begin with the one everyone says and not everyone understands, EBITDA. And if you want to see this full system under pressure, cash, debt, covenants, and a CFO deciding what to say out loud, watch playlist 1 of the main series. Every line ties out to the dollar. That is the promise.